This episode is about answering on the most common questions of you, like, will I get the mortgage? Sounds simple, and it's really simple, as it sounds. So, will I get a mortgage? It sounds like a very general question, but we can kind of separate very general topic. I would close it in I used to call it like three pillars of taking the mortgage. So the first one is gonna be creditworthiness. Simple mathematical approach about your financial ability called creditworthiness. Then the second one is gonna be security. So simply, it's gonna be just the real estate. It can be a plot, it can be a ground, it can be a house, it can be apartment, or whatever what is called real estate, and it's accepted by the bank. So security, real estate. Security. And then after security, the third one is gonna be the risk of the bank. So bank risk. What does it mean? And which one is related with you and which one is related with the external factors? Creditworthiness, it's all about you. It's about your contract, about your salary, all the things that it's on you. Bank risk is related half-half, I would say, to the market and with your personal situation, which is educational, if you're married, if you have a self-employment company, if you have a limited company, or just have a simple contract in a corporation. Everything what is about your posture, your person in the eyes of the bank, because they're gonna judge you, plus the current situation of the market, because the bank is gonna always compare you to different clients. They're gonna pick the clients with lower risk if they have to. For example, if the action of giving the mortgage is limited, or if the market is in higher risk because of something, right? So they're gonna always estimate the risk, and bank is created to earn money, rather to earn money than take any risk, right? So they're gonna try to value the risk very precisely and put it as low as possible. And the security is about, as I said, the real estate is not up to you. It's about literally the physical real estate that you're gonna be secured on. It's not always the real estate that you're buying. It's gonna be something you are secured on. That's a topic I'm gonna bring it up later more precisely, but it's not always the thing you buy, it's the thing where you put the mortgage of the bank. So, to speak about the creditworthiness, we have two very important factors to get familiar with. DTI, it's called debts. It means debts to incomes. Incomes, and should be lower or equal 50%. Why it's so? No one said it's exactly 50%. It's kind of like recommendation of Financial Supervision Agency, committee, KNF, Financial Supervision Committee. It's the institution related with government, and the institution is supervising the banks. They're protecting clients. They're giving the recommendations to the banks, what is allowed to do, what they do not recommend to do, and what they recommend banks to do, right? So they say, in other simple words, that if your net salary, the household income, because it can be only you plus your partner, whatever, if the monthly income that we can accept on this calculation is, for example, 10K net, because we always operate on the net after the tax and all deductions, then your monthly debts, sum of them, so if you have currently some debts, we need to put them here, and then denominator goes Also, the future installment that we're gonna calculate, we're gonna estimate how much you're gonna pay monthly for the new mortgage. So let's say you have some debts here on the nominator. We're putting on the nominator your current debts, monthly installments that you have. If you have any of them, then, if you have zero, then we put around zero. Plus the future installment, that's nominator. And to denominator, we put your 10K of your household. And then we just divide. If we divide, we can easily say that, for example, if the X is gonna be, in this case, X per 10K. From this formula, we easily see that the monthly installment, sum of them, in your case, if you have zero currently, the future one shouldn't be higher than X, and the X is 5K, right? In your case, you can apply to any numbers that you want. So very easily, you can calculate even right now in your head how much is your monthly salary. It's easy to calculate from the contract. If you have a business or more, or you rent apartments and you take some profit from that, it's going to be more complicated because each bank's got own rules. But let's say you're employed, like most of foreigners down here, you're employed in corporation, then it's going to be very easy to apply for your case. So one more time, if your salary is 10 net, you can have the maximum installment around 5K in total, right? It can be 4, it can be sometimes even 6.5, depending on the bank and the bank risk. So far, we understand approx how bank is calculating the creditworthiness in the most simple way. Then the bank is gonna judge you about your, as I said, what is your degree? If you have higher degree or you just finished the mid school, the college, if you are working in a very big corporation for over 20 years or you just started right after studies, all of those things are saying about the probability, the chances that, for example, if something happened, the market collapse or you lose your job, how is the chance for you to get another job? They also gonna check the registers. If you're longer in Poland, they're gonna check BIK. It's quite like a forum where banks are sharing the information about you. They just like kind of gossiping in the special register that if you had any debt, if you have a currently something open, or if you just paid off, they track like 3-5 years back there. So it can really harm you if, for example, you had a credit card or a cash loan and you didn't pay it correctly, you had some delays over 30 days. It can really affect the whole scoring. But if you have positive, even right now you're paying some debts already in the nominator, then then they're gonna see it with each other, right, on this forum, and they're gonna ghost, okay, you can trust this guy, yeah, you can trust him because he's taking money from us and he's paying without any problems. We don't need to call him, we don't need to remind him all the time, so we have no problems with him, and we earn on them as a bank good interest. So they give you kind of like positive recommendation, like referral letter. Of course, it's not like official letter, it's just like a percentage in all this profile that you can log in and track your history. But you can say, all right, I just arrived here to Poland and I have zero history, I had no debts here. Then sometimes, if for example, if we're gonna take your income from abroad, for example, from France or Great Britain, from Great Britain, we're gonna, for example, ask for Experian. Is exactly the same corresponding thing like BIK in Poland. So sometimes they're gonna ask you to generate the report from your own native, where you are from, register. BIK, if you have a business in Poland, then you're also gonna have BIG. It's like, it's hard to translate that. It's just about business purposes. For example, if you have a business, you have a business loans, wherever, and KRRD, it's like country register of debt holders. But to be there, for example, you had internet bill, you stop to pay it, or you had an issue with someone, with another partner, a business partner, and just like they putting it there. Even if you're a physical person, you don't have any business, you can end up in this register if you really don't pay the things you agreed to pay, right? Historically. So here they can be positive or negative, but if you're here, it's always gonna be a negative thing. So bank is gonna always check you. It's one of the first gates on the process. They're gonna check you out on all of those registers. If there is like green light to go afterwards, they're gonna judge your creditworthiness. This is like super long topic. It's gonna be one of the next videos about the source of incomes, the type of taxation, the type of counting this, the way of counting this, and which bank is taking what, because not all of them, they're taking, for example, income from renting apartments. If you have like passive income from renting for a few apartments here, not all of the banks gonna accept that. Then the third one is in the middle, but it's the third because bank is always checking this at the end, is the security, the real estate by itself. And here is a very important thing to distinguish, because you can have a listing price / offered price, depending like how we call it, but let's say listing price. Then we have that's the offered price. Then we have final price, the purchasing price that you agreed on with seller or developer. And then the third one is going to be the real value of the estate. Because, for example, you found a great house or an apartment, whatever, real estate for being on the internet for 1.1 million zlotys, Polish currency zlotys. Then you negotiated down the price up to 1 million, right? So from the listing price, you have a price of, from 1.1, you have a 1 million. But if you go to the bank to evaluate this with professional valuator to do approval of the real estate, you can find out the real value is just 950k, for example, way lower, 50k lower than the real price that you're paying. So the bank is always gonna take the value price, the worth of the real estate on the market, not the listing or the price that you're paying. That's very important to keep in mind. The second thing is that let's say that you have apartment in Warsaw without any mortgage and you want to buy something in Krakow. You can do it with putting the mortgage in Warsaw on your apartment or house instead on the one you buy in Krakow. It's allowed to do. The only one thing is about the LTV. It's loan to value. Should be lower or equal 80%. Why I said 80%, not 90, if 90 is allowed? Yes, you can still go with, the down payment is opposite of this percentage. It's like how much debt you have comparing to divided per value of the apartment. So if the LTV is 80, it means you have 20% of down payment. It's doable still to go with 10%, but the offer is gonna be slightly more expensive and you're gonna have blocked half of the offers. Almost right now, currently, exactly half of the offers of the bank, they're gonna be blocked for you because not all of them, they are allowing you to go with just 10%. This is topic for another video. So, as I said, if your apartment in Warsaw or house is gonna be worth at least enough to divide the price, the purchasing price of the apartment in Krakow by this, you can easily put the mortgage on different estate. They are not related then, okay? So in other words, the apartment you buy in Krakow is without any mortgage, but you took loan for this, and the loan is secured, the bank is secured in Warsaw. One more thing to add here. Here is the price, so let's say the value of the apartment, I'm gonna do V, the value, current value, plus finishing / renovation, because on the primary market we call it finishing of the apartment, and on the secondary market it's renovation of the apartment or the house. If you bought the used house and you just want to improve it, fix some things, then it's gonna be renovating. it gives us the current value plus the future, the renovation, the how I said, finishing / renovation is gonna give us the future value. And it's ultra critically to realize that you put always down payment, not from the value or the price of the apartment that you found you buying, but always from the future value. So in other words, so here's down payment. So in other words, if you found a house for 1 million, or for easy math, for 900K, then you're finishing for 100K, the future value is 1 million. So you need to pay for 1 million, the down payment, correct? If you go with 10%, it's just 100K. If you go with 20%, so LTV it's 80, you need to put 200K. One more time, if for finishing you want 100K and you go with 80% of down payment, it means that you need to put 20,000 more as a down payment. All right, we have it. Then let's go on the timeline. So you understand the order of the things, the dynamics, what's going to happen here when you really apply for the mortgage. That's going to be the moment of being the very firm line, is the moment of notarial act, the moment when you're becoming owner. That's the ownership. So right now we have primary and secondary market. There is significant difference between them. So at the very beginning, we really encourage you to start with checking your creditworthiness, to come by, to talk with us and check all your situation, check your story, to create for you the individual conception. That's always what we do. Our job is to point out the risk. If we see any risk on this transaction, how we estimate the chances that everything's gonna go well. That's our job to do. And then you have green light from us to go to look for the real estate, or really even if you have something you've been thinking about, then just go to developer and book it, or from the secondary market from the seller. So at the very beginning, let's say that you're buying something from the secondary market. Why? Because it's easier. It's easier to explain this dynamic. So here you're coming as a client. First meeting. Client first meeting. The first meeting with the client. Sorry, it's upside down. So then you have a green light to go. You go to the seller on the secondary market, and you have this reservation. Reservation agreement. Reservation agreement. You just have a paper that it's booked for you. Sometimes you pay some down payment, and there is a huge difference in Polish between zaliczka and zadatek. I'm gonna explain later. But one is totally returnable, and the other one, zadatek, you just lose if you quit. It's for different video. Reservation agreement. So after that, they're gonna, in most of the cases, kind of force you to have preliminary contract. On the secondary market, we called it preliminary contract. So you can go, it's like the civil law, you can have it just like between you and the seller, or you can go to the notary and do it in a form of the notary act, right? You're just gonna pay the notary tax for that. But you can do it as well as a civil law, just by your own, on just like a A4 white paper. So you're gonna have this preliminary contract. And then you're gonna have sometimes before, sometimes after. It really depends on the bank, because in some of the banks we don't need to put any papers. We need to point out the address of the estate that you're buying, but we don't need to really put like scan or copy of the contract that you really book it. It varies on the bank. So let's say that here we are applying for the mortgage. So mortgage applications. The mortgage applications, we do almost all of them electronically in our office. So we register, like, we are overpassing the branches. We're going straight to the central of the banks. We have special deals with the over 20 banks right now. I don't want to put the precise number because it's changing dynamically. So we cooperate with all of the banks in the market. Right now it's over 20, and we cooperate in almost all of the cases with just like centrals of the bank. So we go directly to the decision-making people in the central. So you're saving a lot of time and you're overpassing the branches. Then, once we have everything done, you just come by for a coffee, we register everything in one of our offices. Everything is done, the clock, it's set, right? The time starts to flow. So from this point, you need to wait approx, it really depends on the bank, but I would say approx 1 month. Sometimes it's just 3 weeks, sometimes it's 5 or 6 weeks if there's a huge line because they have a great offer. But let's say average is gonna be always over 1 month of waiting time. So you're gonna have some like pre-decision, like pre-positive decision, pre-decision, banking decision, yeah, you know what it's about. So here they are having checked the bank risk, so your scoring plus the creditworthiness. They calculate everything, and on this point they accept you as a person who is applying for the credit. They accepted you, they agreed already on giving you this particular amount of money that you want, that you're willing to get. And afterwards, they're gonna check the security. They're gonna send someone, we have two options, from the bank who is doing internal valuation or external. We highly recommend external one because it's gonna be done very professionally. The professional independent one's gonna go and say exactly how much it's worth, which is real estate. If you do it by the bank, I don't want to say that, okay, and let's face it, if we go internally, because some of the banks, they only allow you this first option, go internally, then almost always we have issues with that. They lower the value, or it's not done properly, they miss something. In our opinion, it's not done professionally. So we really encourage you to go always with the professional external one. So once you have pre-decision, of course you can do the evaluation before, but sometimes it's just like you pay for it once, right? How much? For apartment is going to be approx 600-700. If you go externally, if you go for the house, it can be 1 up to 1.5K, but you just pay once. And if it's external, we can use it to all of the banks that we're applying. If it's internal, it goes only to this internal one. It's slightly cheaper, but you cannot use it to different banks. So in total, globally, effectively, you're losing money if you go internally. Plus the risk that something go wrong and you need to put way higher down payment than you've been expecting because bank lowered the value. So when the valuation is done, I'm not pointing this on the timeline because it can be done anywhere. Then you have the final decision. With the final decision of the bank, then you have a contract with the bank. So contract agreement, banks, how to say it, credit agreement. With the bank. And the first launching of the tranche of the bank, the first money goes always after the being owner, after the ownership, after the notary act. So you have your credit form, you have the credit in your hand, the contract is made, is done, is signed. Then you go to the notary with the seller, the owner, to become the owner. You became the owner, right? To become, and you became the owner. And then afterwards, you're just coming back to the branch of the bank because to do this legal actions, you need to be in a branch of the bank with the sworn translator. They launching based on that. The paper is showing they're launching the credit here. So here the money goes on the account of the seller, and you becoming owner, and the credit is launched. So all your debt is running, you're paying installments, but there is still not a mortgage done. The mortgage is gonna be done by, usually it's like this, that the notary, the lawyer, is going to the court, to special department, and he's putting the request to change the name of the current owner. Plus, on the 4th chapter of the register, it's called Księga Wieczysta. It's the register of the apartment. We putting there the mortgage. Before that, there is something called bridging insurance. It's like expensive addition to this period, because the bank is in the risk, because he gave the money. The owner can go to Bali, wherever, he can just spend it by cash somewhere, the money is gone, but the bank is still not secured on this register on the 4th chapter. So before that, you're paying for this period of bridging insurance. I'm speaking about this way more precisely in one of the videos about the internal things of the offer. So that's it. That's the secondary market, and the primary market. There is a huge difference because with the primary market, you have also like reservation agreement or the development contract. Remember that this is developer contract. So one more time, if you have primary market, then it's called developer contract. If you have a secondary market, it's gonna be called preliminary contract. But it's kind of the same thing, but just with developer contract, there are applied the government rules. There is some law who is more protecting you on the once you're buying from developer. So what's the main difference? That if you're buying from developer and let's say the apartment is not ready yet, because in most of the cases it's under construction. Sometimes it's ready and you're just like ready to go. You just need to pay and you take the key. That's the very, I would say, rare situation. So you buying sometimes ground, just like hole in the ground, they just like starting the construction, or sometimes you're finding the good investment and just buying somewhere in the middle, right? Not all the floors are finished, so you're buying and jumping somewhere in the middle. What does it mean? That they have, I will try to draw here, it's gonna be enough. For example, the developer is gonna require from you 20, 20, 20, 40%. It's all of those are percentage, are percent. So on entry with the developer contract, right now they're gonna, in most of the cases, require 20%. Or if the investment is more advanced, they're gonna require more because already, according to the schedule that different clients had, they already paid more. So sometimes if you're like jumping on the very end of the investment, they're gonna require almost all of it. The last tranche is always like in the moment, like let's say 14 days before the apartment is ready and you are having this protocol with taking the keys from the developer. So it's gonna be here as the last tranche. You have your own, let's say, down payment of 20% because LTV in your case is gonna be 80, so we have 20% of down payment. So that one, it's something you're paying from your own pocket. Where the money goes, they never go to your bank. They always go to developer, or if it's secondary market, to the seller. I recommend to do just the transfer, official transfer with the bank, so you can generate the PDF and everything is proven. Of course, you can bring the cash for the notary on the agreement, but it's way like old school, way more old school. So let's say that you have only 10%, so LTV is 90, you remember. So if you have only 10% and they still require 20 on entry, then you put your own 10% on entry, and the second, the other 10% goes immediately from the loan. So you need the mortgage right away, somewhere here on the entry. So it's way different, as you remember, than the secondary market. On secondary market, the money goes on the very end. On the primary market, you launch the credit, the first tranche on the very beginning. Here is kind of still like, it's not well done by the regulations and whole I would say like situation on the market, like I'm looking for the word, like habits, maybe not even habits, just it is how it is. Because in my opinion, you should get the mortgage way before, like the final positive agreement, way before you look for apartment, so you're safe to go. Just like you go, you find for apartment and just like transfer the money, right? But it's not so so comfy. Currently, and I guess it's gonna be for like long years from now as well, you need to find an apartment, then apply for the mortgage. Sometimes, as I said, you can make the pre-decision without booking the apartment, but still you need to point out that the apartment you want to buy. They need to check the creditworthiness of you, the security of the like value of the apartment, and then it's gonna take like almost 1 month. Then they're gonna give you a final decision. But developer, he wants money right away. He wants to sign after, for example, 7 or 14 days of agreement. He wants to sign with you developer contract, and usually they want it right away. So they're gonna give you maximum like 30 or 40 days to pay the money. You can always negotiate with them, but it's not in every single case so easy to make it like super safe super safe on the timeline. That's why it's so critical to come by on the very beginning to project, to think about all the risks that you can face on the very bumpy road, which is taking the mortgage. It's not simple. So let's say no matter if you have 10 or 20%, you need the mortgage here right away, because let's say this is another quarter. So each quarter, quarter 1, quarter 2, quarter 3, quarter 4. The apartment is going to be ready to use, to give you the keys in 1 year from now. So the quarter 1 is right now, you sign the contract, you need to pay the money, so you need to go through all the process anyway, and the installment goes somewhere here, credit agreement, so you start to pay here in primary market, the primary market. Primary market, and here is secondary market. That's the huge difference. And you may ask the question, like all of the clients, so when I'm starting to pay? And that's a very right question, because you're starting to pay here. It's different story. The bank already gave you the credit. Let's say the monthly installment is gonna be 4,000 per month, which consists of, let's say approx for 30 years, approx for simple math, 2,000 of capital and 2,000 of interest. In this period, in Polish it's called karencja, in this period you are not paying any of the capital, so you took 1 million of debt, you have the monthly installment, and it's just like the numbers are they're random, but you took the debt, you're not paying the capital, and you need to pay right away the interest. You don't pay the full interest part, you pay always proportion. It's super important to understand this part, that if you launch 20%, because 1 million, differently, 1 million is the worth of the security of your house that you're buying, right? The future value. So if you have 20%, then you take only 800K of your loan. So this 800K, it's corresponding to this 80% of the loan, because 100% of these numbers, it's equal 1 million, correct? All of those tranches, sum of them, of these components, they are equal, they're corresponding to 1 million, because that's the value of the apartment, and 800K is just the 80%, because 20% is yours, so it's natural, it's obvious that 80% is the amount of credit. So the monthly installment for that let's say approx, random numbers is gonna be 2,000 of the interest part. And if you launched only 20% of that, then you're gonna pay 20% of this interest part. So in reality, it's just gonna be a few hundreds instead thousands or 2,000s. So you're always gonna pay, in other words, one more time, you're always gonna pay proportionally from the interest part according to how much you used of the credit. And how much you're gonna use, it always depends on the schedule with developer, which is gonna be as a one-off attachment of the developer contract, which says that in 3 months on this date, we require from you another 20%, another 20, and when the apartment is ready, another 40. Then all the credit is gonna be launched before. You're actually gonna get the keys somewhere here. You're gonna finish the apartment, you're gonna live there, and then they're gonna invite you after a few months to the notary to transfer the ownership from the mother register of the ground to create the separated flats, apartments, or if it's the house, then it's gonna be a different story. But the apartments is gonna have own register, and the notary will go to the court in your name to finalize this transaction. So to sum up everything, will you get the mortgage? To answer that, we need to check your creditworthiness, the source of incomes, we need to check your security, we need to speak about a bit about your history, about your risk, about your scoring, those all like very soft part, very hard to estimate in all the transaction. Remember that value, the listing and the listing price and the transaction price is not always the value from the valuation. So value plus the finishing or renovation part gives us the future value, and always from the future value we put down down payment, right? On the timeline, you're gonna have. We encourage you to come by to check everything on the very beginning, then have reservation agreement with the developer or seller, have the regular contract, go with as soon as possible with the mortgage application. Here is the conception. That's why it's so important to create it even before, just to refresh that, to not wait till the last moment. Then you're gonna have pre-decision, final decision, maybe some necessary documents they're gonna ask you for, but it's super rare on the way. Credit agreement, then primary market, where the first tranche of the bank goes on the account of the developer, and the secondary market, where you put everything at once, because there is no this percentage according to the schedule. One more time, primary, you go with the credit, the tranches according to the schedule before. Secondary, you're coming back to the branch of the bank, you're showing that you're owner, and then at once they're gonna pay everything. That's it. To sum up everything, we have 3 pillars of considering the chances to take the mortgage. So the creditworthiness, it's all about you, your salary, your source of income, the DTI formula, this ratio that your monthly installments, some of them, they shouldn't be exceeding half of the monthly incomes in your household, your and your partner. Then we have LTV corresponding to this formula is corresponding to security. You remember that listing price is not the same like value. So if bank valuated the real estate for 1 million, your LTV is 80, it means that you have 20% of the down payment. Then the scoring about your education, your situation, your history of payments, all the kind of soft things to estimate and to judge just only by the experience and the current situation on the market. So that's it. If you have more questions, then you're gonna ask them on the meeting. Thank you for your time.